Hi, I'm Pete Andresen with Andresen and Associates, and I am making this video in a hotel room. I'm across the street from one of those. I'm down here in Los Angeles, across the street from one of those Freefall places where they use a jet of air to have you pretend like you're free falling. And I was thinking, I've done that in the financial markets without the use of, I guess there was a lot of hot air, wasn't there? Okay, I want to talk today about long-term returns and what I'm seeing out there, because it's very important and it explains what I'm doing. And please contact me if you want to discuss your portfolio and how this relates to it. Looking at the long-term return projections that have been put out by most of the investment houses, we have to keep in mind that these are hundreds of extremely highly paid people, and we're supposed to trust them. We're supposed to listen to what they have to say. And here's what they're saying, basically. Here's a Morningstar graph. Take a look at this thing. This is an interesting thing. You can see that bonds are back in a very nice way. Bonds are back. International is projected to do great, which it has not done in years. It did last year. Last year it did fine, and then look at the stock market. What they're projecting in general is that the stock market really doesn't do so well compared to long-term history. Let's take a look. This is from A Wealth of Common Sense. Hold on. There it is. Okay, A Wealth of Common Sense. I'll put the link below for you. I'll put the links below for all these fascinating projections. But this one is long-term returns looking backwards. And it looks, frankly, it looks awesome. I mean, look at how great it's done over the long term if you just buy and hold in the stock market. That's S&P 500 large caps, dominated by, right now, the Magnificent Seven. Okay, now let's go back to that Morningstar chart, that graph. Take a look. It's projecting below normal returns for the next decade or so. And Fidelity does, I think, 20 years, so it's not on here, but they're pretty much on par with that. So what are they saying, really? Are we going to have a long period of, like a decade of subpar returns? First comment, they've been wrong for years, and mostly because of Fed stimulus. They've been wrong in the past for a variety of reasons, but mostly it's been the Fed stimulating, the Fed messing with the economy. And debt creation, which, I mean, nobody expected the amount of debt creation. So they've been wrong. That's the first thing. But I have to pay attention. These are genuinely people who have studied their rear ends off about this, and they are not being compensated more for putting these dismal expectations out. In fact, it's diminishing the likelihood that people are going to invest with their firms. So when they put stuff out like this, I should be paying attention on behalf of your money. What I think is out there potentially, big key word, giant keyword, potentially, is this. Take a look at this graph. This was created by me on a Morningstar format. You can see that the S&P 500, the large cap, got overvalued in the late 1990s. And then you had the, quote, lost decade, end quote. But it was not a lost decade if you were in small caps, if you were in internationals, if you were in value stocks. It was anything but. It was a good year, good 10 years. It was good. This is from the start of the long-term Vanguard Treasury Fund, so it's a little off cycle, but it gets the point across. Now, there's another thing to look at in this graph, and that is that a period of return where the S&P 500 goes negative for a decade, and mildly, but it does go negative. NASDAQ, as you can see, at one point is down about 70% during this decade. But what really stands out here is that there's not an average, it doesn't do something like 4%, 4%, 4%, 4%. It goes down. There's a big, giant drop, which does not find itself reflected on the bond side or the international side. And that's why, this is key, this is why you are so diversified. If we're going to sail into a storm, we know from history that diversification often does quite well. So that explains why the diversification. Now, I have had clients say, how come so many mutual funds? And just as I said in a prior video, the reason is I'm trying to hire all those good minds going in. This is a situation where you can have more than one driver, and why not hire them? They've been good over the decades before. So, expectations for the coming decade? Pretty mediocre, actually, but not once you step outside the S&P 500, which is now the dominant stock market index. Now, what am I going to do? Nothing in your portfolios at this time, because you're already there. You're already diversified. I'm going to respond to downturns by buying, and I am going to buy bargains. But as we just saw in 2023, overreacting to these predictions can produce a lot of chaos. I especially am not going to rebalance in taxable accounts and incur taxes. So, on we go. Contact me if you want to discuss this further. But this explains a lot in your portfolio, doesn't it? Thank you very much. I guess I'll go scare the snuff. No, let's not. And blessings.